For over 100 years, investing felt like a science. You analyzed earnings, you checked cash flows, and you waited for gravity to pull prices back to reality. But somewhere between the 2020 pandemic and the rise of AI-driven trading, the anchor was cut. Today, investing feels less like analysis and more like watching a game of Wheel of Fortune. We have entered an era where a single viral narrative or a sentiment shift can move billions of dollars faster than a 500-page earnings report ever could. If you're feeling unsettled, if you're wondering why cheap stocks stay cheap while expensive stocks keep hitting the moon, it's because the relationship between market price and fundamentals is no longer on speaking terms. Today, I'm going to show you why even the legends are struggling and what actually drives the markets in 2026. Let's look at the numbers that don't lie. Experience used to be an advantage. Now it's becoming a liability. Take Michael Burry, the man who famously profited $800 million by betting against the 2008 housing crash. He is the human embodiment of trusting the numbers. Yet he recently admitted that his estimation of value is no longer in sync with the markets. In his own words, the market has stopped pricing assets based on their actual worth. Whether it's equities, real estate, or crypto, the disconnect is universal. If the market can stay irrational longer than you can stay solvent, then traditional value investing stops being a viable strategy. If fundamentals aren't driving prices anymore, then what is? The answer is human behavior. Traditional finance assumes markets are efficient and rational. Behavioral finance assumes markets are human. It proves that we fear losses more than we value gains, and that we instinctively follow the crowd. Post-2020, this shifted from a theory to the core operating system of the market. We've moved from asking, "What is this company worth?" to, "How will people react to this news?" Information doesn't spread over months anymore. It collapses into hours through the internet. When enough people agree on a story, the narrative becomes the price. Even institutions are now incorporating online sentiment analysis because it explains price action better than traditional metrics ever could. So, is this a temporary bubble or a permanent structural shift in the markets? History tells us that gravity eventually shows up, but the rise of digital participation might have changed the gravity constant forever. We are living in an investment landscape that prices attention over cash flow. The real question isn't whether the market feels strange. It's whether you can adapt to this new regime before it's too late. I want to hear from you. Do you think we're just in a massive bubble, or has the game of investing fundamentally changed? Drop your take in the comments below. I'll be reading through them. If you found value in this breakdown, hit that subscribe button and turn on notifications. Stay sharp, stay informed, and I'll see you in the next video.